We're going to dive into three of our top stories now on inflation, Nigeria's external reserves, and the exchange rate. We have Bismarck Rewane, MD, CEO of Financial Derivatives, and a renowned economist joining us again in the studio. Always great to have you with us in the studio, Mr. Rewane.
Thank you for having me.
So I call this a trifecta of issues because there are three, and they're kind of all intertwined.
Yes.
So my first question will be really around external reserves. What can we do to stem the decline? Because external reserves are meant to be a defense mechanism for us, surely.
Well, the first thing to know about external reserves. What the true value of external reserves? Nigeria publishes gross external reserves. Nigeria publishes the 30-day moving average of the gross external reserves. Every country in the world publishes the net external reserves. External reserves free of encumbrance and what we call free and clear. We don't know that. Therefore, people are speculating what is the true level of external reserves. So that's the first thing. Secondly, are these reserves in a form that can be used to defend the currency? And how do you want to go about defending the currency? That is the important thing. What constitutes reserves are your special drawing rights, your gold, and then your reserve currencies. In this case, we have the US dollar, we have some yuan, and I think a little bit of British pounds and euros here and there. So I don't know exactly what the net figure is, and there's no point speculating. But the reality is that if the net figures are published eventually, when the audited accounts of the central bank are released, and you find out that those figures are far from what the published gross reserves are, then the market will actually take that into consideration in determining your capacity to support your currency at what they consider to be fair value.
So are you saying if they come out significantly lower, that we may see a significant further decline in the Naira's value?
Absolutely, yeah. Because the question of data integrity is as important as the data itself. So what is the nominal value of or illusory value of your reserves, and what are the real value of reserves after discounting for this bookkeeping cosmetics?
So you mentioned encumbrances. So part of our reserves, are they going towards servicing debt?
No, encumbrances mean that if, for example, I have gone into a swap arrangement with a bank.
Right.
Okay, and the bank gives me dollars that it's holding. Let me say Bank X in Nigeria gives me $2 billion, and I give that bank the Naira equivalent with a repurchase agreement. Now, the bank now says I want my $2 billion because I have to meet my obligations. You have to cough it up. So basically what you need to do is to say my gross reserves less these sweetheart arrangements, right, will give you a figure. And then that is one. Two, there are transactions that encumber our cash flow, even though not in reserves. If, for example, you went into arrangement with the Chinese that were building the Lagos-Ibadan rail, you are out of pocket to the tune of $4 or $5 billion, and that over the next 3 to 4 years, you would be selling me oil if you don't have the cash of that. So that means that ab initio, you would have to cough up that amount of dollars in oil, which reduces your cash flow. I think that's important. But after considering everything, the point you must note is that the reserves are a stock of wealth.
Yes.
A stock has a fixed value and gets eroded over time. But it's the flow that is important. So in a bathtub, what is in the bath is important. But it is what is coming in versus what is going out. Right? So that is where the whole process. So yes, I agree that the reserves are important, but let us focus on the cash flow. Is the cash flow in dollar terms relative to the outflow in dollar terms that determines what the currency
Because that's what replenishes the reserves, essentially.
Absolutely.
And of course, closely tied to that is the exchange rate. And I'm sort of almost tempted to ask you, is the Naira in free fall? But at the same time, but we've also seen that convergence now start to reverse.
Yes.
So how can we stem that tide?
No, you see, again, the biggest problem here, and there are all sorts of, even as economists make that mistake, we get carried away by the difference between an exchange rate and an exchange rate determining mechanism.
Yes.
So an exchange rate is a number. What is it? It is 780 or 750. But 750 could be fair value at 8 o'clock in the morning. By 8:05,
it's changed.
It's changed.
Yeah.
So what system is being used to keep your exchange rate from being misaligned fundamentally? I think that's the key issue. The exchange rate is misaligned because there are certain things that are being done. You know, you are holding some variables constant while you are allowing some other variables to change. No variable is constant. Any economist who tells that the variable is constant is practicing what we call partial equilibrium analysis. It doesn't work. So let us go back to the original pronouncement. Pronouncement number 1 is that subsidy is gone, which means, and we'll come back to the implications of that. Pronouncement number 2 is that unify your exchange rates. Pronouncement number 3 is that the dollar, that investors will get their money out. Pronouncement number 4 is that we will bring interest rates down. Pronouncement number 4 is inconsistent with pronouncement number 1 and 2. You can't do that. It's intuitively.
That's the interest rates.
The interest rate,
in fact,
yes.
we're waiting to see what happens next.
No, so in fact they did.
That's not even likely to happen given this.
No, that is the policy rate. The policy rate is an anchor. A ship without an anchor, is
going to drift.
That is exactly what it is.
Yeah.
That rate is at 18.5. Maybe it goes to 19, right? But it's meaningless. The most important rate is the rate at which the treasury bills are trading, right? The risk-free rate. The risk-free rate for Nigerian treasury bills for 1 year is slightly above 5%. The risk-free rate for the U.S. treasury bills about 2%. Inflation rate in the U.S. is 3% right now. It's come down to 3%. While inflation rate in Nigeria annualized is 22.7, right? 22.8 actually. But if you take the monthly inflation and annualize it, it's actually about 28%. So the difference between 28, right, and 3 is 25%. And your treasury bills are trading at about, so you have about 23% worth of interest rates to bring your interest rates and your exchange rate into equilibrium. It is as simple as that. It's not a rocket science. So, but you see, this is a time when the people running the monetary policy have to be able to look at the principle and say, look, you can't do this. And if you do it at this time, the consequence is that.
Significant. So if I will just pick on, because you mentioned the people running the monetary policy, and what we were talking about just before we started the show was that we've had a lot of policy pronouncements.
Yes.
But in terms of the institutional structure to kind of anchor that and backing that, we haven't seen those moves yet. So what really needs to happen to give confidence to the market that we might even be moving in the right direction?
Well, the markets always give you some room, right? So, and there's a sequence of things. The policy changes are the easy part. Those are sound bites. Anybody can announce that talk is cheap. But institutional reform to ensure that these policies actually begin to achieve the desired objective, and the feedback mechanism from the market, so that you can adjust them. There have been some adjustments, but adjustments that appear on the face of it as ideological backsliding, which is reversing yourself, is a very dangerous phenomenon. The EIU came out this week, actually July last week, and said in their projections that they think that Nigeria will go back to a much more controlled environment than post-reform.
When they say controlled, in relation to the exchange rate?
Everything.
So this kind of liberalized regime?
When push comes to shove, that is their view. I don't agree with that Nigeria will not be able to stay the course because of deep-rooted vested interest, right? And turkeys don't vote for Christmas, right? So that's the fear But I don't think so. I think that my personal view is that the inadequate dose, we would have to go ahead because we have no choice. 2, if new money does not come in, right, then there's a problem. But let's reflect on what the exchange rate is. There's a difference between the quantity supplied of a product and the aggregate supply of that product. Let me explain it to Nigerians. The truth is that the quantity supplied means that you are increasing the quantity at a price on the same supply curve. But if there's a shift in the aggregate supply curve, right, it means that something fundamental has happened, i.e., you have dealt with your oil theft, OPEC has lifted your quota and all that. Therefore, instead of having $2 billion a month, you are now having $3 or $4 billion a month. You are able then to go into the market and intervene at whatever price and maintain some kind of stability. But if that doesn't happen, if you do not have a deal, have a policy support instrument program from the IMF, and you don't have new money from the Paris Club and London Club, which now gives you the capacity, right, to actually supply that market in greater quantities, right, you actually shift that supply curve. And that coincides also with the fact that your oil production and price is also let us assume that that increases because you are now fighting. All of these things will lead to a situation where your naira begins to approach fair value.
Okay.
And fair value is anything between 650 to 680, and at the time it was looked at by Bank of America, JP Morgan. But if alternatively, rather than doing that, you just announce a rate, then you have some restrictions, you open up, and let us see what happened. They paid off the $500 million bond.
They still have other dollar liabilities.
Oh yes, a lot of them.
Yeah.
So people are actually looking closely, and you will notice that none of the rating agencies have come out to. They've been quiet. They're watching. One, they want to know what those net reserves are. 2, what kind of policy support program you are going to have. And 3, what are your creditors, right? What are they going to do? Are you going to have to do something fundamental? And then 4, what happens on Tuesday? 1, with your MPR signaling rate. And 2, what's going to happen to your effective interest rates? Well, interest rates came down to as low as 2% in the overnight market, but then as if that is not bad enough, we now sent a signal by reducing the CRR for merchant bank 10%, which means you are loosening the monetary conditions worse than what they are. When monetary conditions are loose, monetary policy must be tight.
Yeah.
Right?
So speaking of monetary policy, I mean, all the indicators now are pointing to another hike.
Yes,
right?
Definitely.
Do you have a sense? I mean, I feel like we're kind of backed into a corner. We have no choice but to move in that. But do you have a sense of just how big that hike might be?
I would say,
or how big it needs to be, maybe.
No, it needs to. I would say maybe 50 basis points, right? Because you don't want to be so disruptive, right? But at the same time, that is a meaningless move because not much is tied to the MPR, right?
Yeah.
So let us assume that you went by 50 basis points, but then you have already reduced CRR for merchant banks, and then you reduce CRR again, right? Which means you're putting more money into the system, and then you go back to money. It's
biting your nose to spite your face.
You see, you're basically what is happening now. You're scoring an own goal and then equalizing and saying that you are taking credit because you created the problem in the first place. So the Nigerian system must understand how to differentiate between symptoms and causes, right? The cause of the misalignment is there, and the symptoms of the misalignment, and then you know what you do. When we started this program, you announced that money supply was at 64 trillion naira. That's a very interesting number.
Yeah.
Money supply growth in the last has been over 15-16% in the last 2 months. If your money supply growth is 15% and your output growth, your GDP growth for the year is 2%, have an issue before you start. You are 13% inflation number.
Of course.
Then you now take the exchange rate effect, pass-through effect on domestic prices, and that has what we call some effect on your tradable, right? You now go further and now say that the exchange rate used for computing import duty before was 412. It went to 587. It's now 770. What has happened now? The flour millers have increased the price of flour about 2 weeks ago by 5% to reflect the 587 naira import duty. They would have to do that again. And the bakers have said, okay, thank you very much. The price of diesel is stable, but we are announcing on the 27th, they've announced it, a 15% increase in the price of a loaf of bread. So let's look at it. The bread goes up by 15% on the 27th. Tomatoes is now at 90,000 naira a basket, right? Peppers are slightly lower than that. So you have bread, pepper, tomatoes, and vegetable oil. So you can see that all of a sudden that food basket is going to, between June and July, it's going to spike quite significantly. So we are
Mr.
in a tight spot.
You know, I'm at pains to ask you, can you give me a silver lining? Because, you know, we're seeing these challenges. We know there's clearly an end goal in point. We heard about the slight backtracking on the cash transfer program. People are suffering on the streets. You're seeing what's happening with the fuel prices and food prices. Now we're talking about Russia. It's having a domestic impact. What's the good news? Give us some meat.
Let me tell you the good news.
As we wrap up, we need to wrap up.
The bad news is that there's pain. There will be more pain in the short run. But the good news is that there will be gains in first quarter of 2024. I used to think that you get that sooner.
That's not so far away, but
no,
for
not
a
so
lot
far
of
away,
people,
but
it's...
You need to have your supplementary budget. You need to recycle money into the system. Talk of wage review at this time is quite, that's a poison chalice.
Yes.
So, yes, wages have to be reviewed, but now an increase in money supply without an increase in productivity is a major challenge.
Yes.
It sounds easy to say, okay, make this.
It's just going to push our inflation figures higher.
Absolutely, but we are not alone. You see, in Ghana, it went up all the way to 52, 53%, now down to about 40%. South Africa, the rand went all the way to 19, it's now 17. The Ghanaian cedi has also started appreciating. So we are not going to have a situation, a runaway situation. It only means that we have to take that third step of increasing our domestic interest rates, the effective domestic interest rates, to a point where the economy is in equilibrium.
Yeah.
You cannot have 1 and 2 and then escape 3. It's like going to a pharmacy and say, okay, I like this cough medicine because it's sweet, and I don't want this one. You can't.
You need all of them.
You need all of them.
Thank you so much, Bismarck Rewane, a renowned economist, offering some deep insights on the future of the Nigerian economy and what might be to come in the next few weeks.